G'day, I'm Jonathan Bays, and this is our May investment market update. And this month we're pleased to say Dr Graeme Shaw from the Orbis Global Equity Fund is with us to leave his thoughts on how the fund is positioned and thoughts on investments going forward.
My name's Graeme Shaw. I've worked at Orbis for 20 years and I'm currently a director here in Australia. A good place to start when thinking about investments is to look at where interest rates currently sit in the cycle. There's a nice paper from the Bank of England that show interest rates going back 700 years. And when you look at current rates, which are somewhere between -0.5% and 2.5% across the major economies, what you'll notice is they're extraordinarily low compared to the rates we've had in the last 700 years. And this has had a really big impact on asset prices. It's tended to drive up the prices across most of the asset classes investors rely on. For example, in many parts of the world, you'll find that residential property prices are very high compared to rents. If you look in the corporate bond market, the additional yield you get from lending to companies is well below long-term averages. And even the stock market looks pretty high compared to average inflation-adjusted earnings. So this is a little bit of a tough thing for investors to face going forward, and it would be easy to get despondent, but there is some good news here. If you delve below those large asset class levels, you can still find plenty of investment opportunities that offer reasonable prices. A good example of this is to look at the stock market. Some people will say the Shiller PE for global equities is really high and higher than history, and that's true, but that's very influenced by the US market. Once you strip out the US market and look at the other parts of the world, you'll find the Shiller PE isn't particularly high, and in fact in places like emerging markets, it's actually pretty low today. Another effect that very low interest rates has had occurs within stock markets. You've seen these low rates force a lot of investors out of the bond market, and they've come into the stock market looking to replicate the stable earnings and decent yields that they used to expect from the bond market. This has driven the valuations of stable shares up to very high levels. And if you look at a graph of the price to book of the defensive parts of the market relative to the market as a whole, what you'll see is defensive shares are trading at the upper end of the historical range. The other effect low interest rates has had in the stock market is it's caused growth stocks to appreciate a lot relative to value stocks. The market tends to reason that growth stocks are more interest rate sensitive, so when rates fall, growth stocks tend to outperform and value stocks tend to underperform. And that is a reasonable thing to happen, but the degree to which that has gone on is now extreme. If you look at a valuation of growth shares versus value over time, you'll see that growth shares are now as expensive, or almost as expensive as they were at the top of the tech bubble, which was a particularly dangerous time to own growth stocks. So putting it all together, when you look at the portfolio Orbis has built for our clients, you tend to find it is overweight emerging markets because that's where we find more value and that's where earnings are less overstated than in places like the US.
At risk of sounding like a broken record, we continue to be cautious on risky assets, in large part because it just feels like there's such a huge amount of hope being priced into global share markets, both in the US and the rest of the world, but also too here in Australia. Locally, we've talked about the federal election and potential change in government and the increased taxation on people's assets that will bring. We've had a continued decline in the economy locally, particularly on the residential construction side. In the past week, we've seen March building approvals for new private homes fall to a 6-year low. Building approvals we've spoken of before lead actual residential construction activity by about 6 months. So there's no uptick coming in residential construction markets that I can see, at least in 2019. And in a global sense, markets remain very strong despite the fact that the economy continues to ease as we speak. You know, manufacturing in China and the United States continues to be at least a 6-month low, but you know, in the United States last month, it's actually at a 2-year low, and worse than that, new orders are now growing at lesser rate than inventory. So we have the risk of a potential inventory destock coming, and that's also without taking into account the ongoing, I guess, battle between both the US and China on the trade front, and the prospect of higher tariffs that could arise there, which clearly would be very negative for global growth. On the stock front, the Aussie equity portfolio actually continues to do quite well year to date. Amcor, which is one of the larger holdings, continues to power ahead as we get closer to consummation of their merger with Bemis. It's been a great outperformer, Amcor, and likely to continue outperforming. We think if the Australian dollar continues to trade under 70 cents, as we certainly anticipated to do so. Afterpay has blazed a trail for us and now north of $28. So we are in the habit of, or in the process of taking a bit of profit in Afterpay. We've had a long-standing target this past 12 months of $25 to $30. We had the scheme of arrangement for HealthScope increasingly get closer to going ahead. The largest shareholder there, Australian Super, has indicated that they're going to accept the offer. So we're getting very closer to an end game there at $2.50, so that's been a positive bit of news as well. But on the whole, we continue to retain quite a significant amount of cash in light of our cautious view, and we really hope that through the course of the next couple of months, we'll see opportunities arise again at which to deploy that cash.